Thank you all for joining us today in Bulletproof Your 2023 Budget with FX Scenario Forecasting. The webinar today is sponsored by Datarails, a financial planning and analysis platform for Excel users, in partnership with Monex USA, a global payment solution. My name is Roxanne Pomerantz. I'm a product marketing manager at Datarails. I'm very happy to introduce you to our lovely panel today. We have John Min. He is Chief Economist with Monex USA. He's responsible for working with corporate clients in mitigating and managing their foreign exchange risks. John also teaches economics at Northern Virginia Community College and Master of Finance courses at New England College of Business and Finance and London Academy of Trading. We also have Emmanuel Serrano, Director of Strategic Partnership at Monex USA, where he's helped start and develop its partnership program. Emmanuel has spent the last decade working directly with corporate clients in streamlining global payments, managing their FX risks, and optimizing global cash management. And Jonathan Yahalom is the Director of Presales and FP&A Solutions Consultants at Datarails. He has over a decade of experience from multinational companies, including PepsiCo. And Jonathan is an expert at financial planning and analysis and financial modeling. So welcome, everybody. Excited to get this chat started. Now, the first thing that we're going to do is a quick poll. We want to hear from the audience your thoughts about inflation, because as we know, we're in a difficult economic period. So a good topic to start off the webinar is, how do you think inflation will change in 2023? So I'll give you about 1 minute to answer, and then we'll hear from the experts a little bit about what's happening in this recession, what we should know going into the next year, and here's some best practices. All right, about half of the participants have answered already. That's great. I'll give you a few more seconds to put in your answers. Awesome. So we got 19 answers, and there is an overwhelming trend that people think inflation is going to remain high, meaning above 4% in 2023. We also have a couple answers. Some people think it will be far worse. Some people actually think it will be under control in the next year. And one person is willing to admit they really have no idea. Oh, I didn't click share the results. Sorry, now you can see them.
Wow.
Interesting, huh? So now I'll ask the panel. Considering that 2022 was a year full of economic uncertainty, if you could each pick one or maybe two best practices for multinational companies that are finalizing their budgets during a recession, what would that be? What would that recommendation be?
You know, I would say, and I've been on the road for the past 4 weeks visiting companies and talking about exactly the same thing, trying to help them figure out what the weather is going to be for 2023. I think the best practice I see is out of necessity, which is you should do scenario-based, just like the title of this webinar, because right now market consensus is there's 25% chance we may not see a recession in the US tomorrow, which means the Fed has done a good job soft landing. But then there is a 50% chance we'll have a mild recession second half of the year. And then there's 25% probability that it's going to be very bad recession, like back in the early 80s. So it would be nice for the CFO or the CEO or the folks who are doing budgeting to see what their numbers would look like in this scenario versus that. And then you can kind of see the framework for setting the budget, whether it's going to be consensus-based or the mid-based, or is it going to have a bias towards one scenario or another. So yeah, playing 3 different scenarios makes a very good sense.
Interesting. Yeah, it looks like, you know, as you said, it could go either way. So having a good scenario analysis to determine how we can be ready is a great way to be prepared.
what's really interesting is that all that is going to be determined by 19 people who meet every 6 weeks. Right down the street from us in Washington, D.C. is the Federal Reserve Board, FOMC. And it all comes down to how high they're going to raise the interest rate in the next 6 months.
Interesting.
John, that's a great point. I think from the conversations that we had yesterday and what we're seeing from the meetings is it's really hard to know what's going to happen. So just being prepared, having a budget, analyzing what the forecasting is going to be like, and having a 3-case scenario where you're preparing not only to be able to protect on what you're forecasting, but yet at the same time forecasting for the worst case scenario, it allows you to be prepared and at the same time just have an idea of what could happen.
Exactly. And one thing I do recommend when you're doing this, when you're figuring out the budget, implications of China opening up now. And that was not expected at all. It's almost like they ripped the Band-Aid off and they're just going to open up. And what that means is commodity price is going to go up again. Oil price is going to go up. There will be a surge of demand from China again. And if that's the case, then inflation, I do agree there's a chance with the two gentlemen who says inflation could be worse. And you may see restart of inflation, which means the Fed has to raise interest rate even more. And that could crush the US economy, especially the housing side.
Wow.
And just I guess to add to that, I agree that scenario analysis is key and you need to prepare. It's not just about the forecasting though. You need to actually have a plan for how you'd handle each of the scenarios, probably reforecasting and keeping a close eye on it throughout the year. And then, be prepared to go to the worst case scenario if you need to, and just have all your ducks in a row before you get there.
I agree with that 100% because we're advising our clients, especially when it comes to the foreign exchange part, you need to reevaluate on a quarterly basis because our FX models that we use internally to forecast, it kind of gives us a good view which way the dollar is going to go against different currencies for the next 3 months. But beyond 3 months is very cloudy. And if there's anyone out there who knows where the dollar is going to be 12 months from today, I don't believe it. But we do have a pretty good view of where the dollar is going to be in 3 months. So I think everyone needs to sit down on a quarterly basis and reassess and run the scenario again with the latest data. By the way, that's what the Fed is doing too. They can't see anything beyond 3 months.
Thank you. Okay, I have another question. So this is open to anyone who would like to answer it. Based on your professional experience, could you describe a time when you saw something that worked really well as a recession preparation practice, or alternatively something that went terribly, and how would you would fix it if you had the chance? Like an anecdote from your experience?
Yes, it's a large multinational out of Texas, and they didn't have any hedging policy. So when the dollars start to surge, second half of this year, they were reacting to it, but they didn't have any policy to say we will hedge this much. Is it 50%? Is it 80%? 20%? So they're having these conversations when the events were happening. So they're always catching up to what's happening out there in the economics and the financial marketplaces. So my recommendation is, if you don't have an internal hedging policy, if you're really conservative, 80% is hedged. If you're very aggressive, risk-taking, maybe 50% or 25%. But it is important to sit down, have a meeting among the executives and have a consensus. Our company's policy is we're going to be risk averse. We're going to hedge 60, 80, whatever the percent, and agree to it. And when the situation happens, you have a playbook. They know exactly what to do instead of reacting and panicking.
Interesting. Yeah. So what you're saying is that collaboration and communication is key, that the company's leaders should really find the time to sit down and speak together and discuss what may happen and how they as a company are going to respond to it.
Exactly. You should have a plan in place before going into 2023, obviously.
Mm-hmm.
That's a great point. I think John is emphasizing on the positive, right? In this specific scenario, you had a US dollar positive movement. What I've seen is I've also seen it on the negative side, right? If you remember right before COVID, you ended up seeing that the US dollar was semi-strong, but then all of a sudden it ended up starting to lose a lot of traction and it ended up going above the 1.20 versus the euro. So the inverse of what John was talking about happened, and that somebody that was looking to be able to capitalize on their bills, but yet the currency was running away from them, they ended up having to pay an additional 20% on the invoices that they had accounted for just in a period of 6 months. So
Wow.
if you're not hedging, if you're not forecasting, you just don't know what's going to happen. And if you don't have a hedging policy in place, it could definitely impact your profitability.
And the regard to the impact, NYU, their business school Stern, they publish a average gross profit margin for different industries globally. And if you exclude financial industry, retail, commodities, the average profit margin, gross margin, is about roughly 5 to 10% for most of the industries. Well, if the currency moved this year, US dollar moved over 12% against most of the major currencies. So if you're on the wrong side, if you're an exporter, your entire budgeted profit could be wiped out if you don't pay attention and you don't hedge and you don't pay attention to the effect of strong dollar. By the way, that happened to Microsoft. It didn't wipe out the entire earnings, but stock took a hit because their foreign earnings were much less when they converted to US dollars last quarter. And that's in spite of them hedging 50% of their cash flow. That's their hedging policy.
Interesting.
Yeah, I worked on a hedging for materials, which I guess is one step removed, right? In also a large multinational company where the product that I worked on was like oil-based, okay, resin type of product, and that's also had a huge impact on the organization when the pricing was shifting pretty drastically from one period to the next. We did implement a pretty strong hedging policy there. So definitely recommend looking into the hedging.
Great. Thank you, the three of you, for sharing your experience and also referring to, what happened with Microsoft recently that many people have heard about. So I'm going to move us right into the next poll that I've prepared for the audience. All right. Okay, so the poll is talking about the next topic, which is specifically on FX forecasting, as we've already mentioned. So first, we'd love to hear from the audience. How are you currently doing FX forecasting? Or maybe you're not. And secondly, what would help you improve your forecasting process? So the poll is live. Please take 30 more seconds to answer it. And we would love to address that in the discussion of our next question. So maybe you've not started doing FX forecasting because you don't see the need. Maybe you want to do FX forecasting, but you haven't started yet for one reason or another. Maybe you're already doing it and you think you have a pretty good handle on it. You feel like it's frequent enough. Or maybe you're doing FX forecasting and you're really not sure if you're doing it at the right time. Or maybe it's just not frequent enough. And secondly, what would help you improve your FX forecasting the most? Is it more time? Is it better tools? Is it a data accessibility problem? Do you need more buy-in from management? Or is the collaboration not there to let the forecasting happen the way that you want it? So I'm sharing the results now. It looks like the majority, it's pretty even. We have kind of a bell curve result here. And, it's actually completely even between participants who want to forecast FX but have not yet started, and participants who are forecasting FX and they think that they've got it figured out in terms of how often they're doing it. A few people aren't doing it at all because they don't see the need. So I suppose they're here to learn why maybe they should start doing it. And someone who is doing FX forecasting but isn't quite sure if they're doing it at the right time. And then it turns out that data accessibility is actually the biggest factor that could help people improve their FX forecasting. And some people are looking for better FX forecasting tools. Very interesting. So I'm going to close those results now and jump into the next question. So before we talk about best practices on FX forecasting, I want to ask you, why do you think it's necessary in the first place to do FX forecasting? How come a plain old budget without it isn't enough? Now, Emmanuel, you did touch on this question in your previous answer a bit, and we talked about kind of the risks when you don't have hedging into practice. So does someone want to follow up?
Yeah, you know, if we're having this conversation or webinar 10 years ago, even 5 years ago, there are a lot of companies in the United States, over 50%, they don't hedge their foreign exchange. And if you ask the CFO, the logic of it is, you know what? No one really knows. So dollar may go up this year, dollar may go down next year by 5%, up 5%, down 5%. Eventually we'll net it out. So I'm not going to pretend like I have a crystal ball and do anything, because sometimes hedging can be expensive, especially options and when you structure it. That worked really well. The problem in the current environment is the volatility is extreme. So if you look at pound sterling, we looked at just last 3 months, movement of 20%. Japanese yen is a shocker. I'm still shocked by it. The yen versus the dollar moved 40%. Pretty much all the Asian currencies that get to the dollar is 20 to 25%. So now you cannot afford to hedge because it's not going to even out just like even 5 years ago. So if you don't hedge, and let's say you're exporting it to Japan, oh wow, your expected profit is reduced by 40%. By the way, the flip side of that is that if you're sourcing things from Japan and things like that, or even euro, the euro moved 12% this year. So the degree of volatility is so high, I would argue you cannot afford not hedging. Yeah, it's the absolute best practice for next year.
If I may add, and this is, I'm going to try to make it more relevant to the roles of the accountants and the CFOs. What we notice is, whenever it is that you're looking to hedge, it's not to speculate, it's to be able to protect against your budgeted rate. Because what you want to do is you want to make sure that you're not showing FX losses, right? Going back to the examples that John Meng is talking about, if the currency moves 20% against you, and at the end of the day, at the end of the month, you're showing a 20% FX loss, it doesn't look good on you, but yet at the same time, it wasn't your fault. That was just the difference between the net payables of when you received the invoice and when you executed the invoice. So I think, the reason why it's important for accountants and CFOs to be able to have an FX forecasting is so that they remove FX losses.
Nice. So what I'm hearing is that the market is much more volatile than it used to be. And you don't want those FX losses showing up on your reports at the end of the year, especially in a time where money isn't quite as accessible as it used to be. You want to make sure that your company is showing up right and you're taking every precaution possible. So, Jonathan, do you have some FP&A perspective to add to this point?
Yeah, from my experience, there's a combination of a few things. One of them is, as we said before, doing the multiple scenarios. I know it's a little bit tough when you're working a lot in like Excel all day long, at least it was for me. Utilizing a database approach to it, it's just a lot easier way to understand how the different scenarios would impact you, because there's a lot of different layers to it. And then, implementing the hedging, that'll get you to the consistency so that you could focus on running the business instead of paying attention to currency movements. So, if you are large enough that you can, keep, let's say, move to purchasing from one region or another and all that, that's really nice, but not everybody has that flexibility, in their organization.
Thank you. So with that, I'll move us into the next poll, which is focusing on scenario analysis. So the nature of this question is similar to the previous one. We want to hear, how would you describe your scenario analysis process today? Are you performing scenario analysis? What's your confidence in it? The poll is live, so please submit your answers. I'll give you a minute to do so. And then secondly, let us know what would help you the most to improve your scenario modeling and analysis process. Are you missing the tools to do your models? Are you missing the tools to do your analysis? Are you maybe, again, having a problem accessing all of your data from all of your different systems in one place where you can actually see the big picture? I'll give you 10 more seconds to fill in the poll, and then I'll share the results. Great. So what do we have here? It seems pretty clear that there is a need for scenario analysis. Everyone either says we got 30% of the audience saying they would like to do scenario analysis, but have not started yet. I guess we'll see why in the next question. 65% of our audience is performing scenario analysis, and they think that they've got the timing correct, like they're doing it as needed. And a part of the audience is doing scenario analysis, but is not quite confident that it's serving their needs. And next, when I ask what would help you improve your scenario modeling and analysis process the most, the results are spread pretty evenly. A few people say they need more time to do it. The most popular answer was split between a need for better modeling tools and a need to be able to access their data more effectively. There were also votes for better analysis tools, management buy-in, and more efficient collaboration. So it seems like the answers here actually describe pretty well some of the issues that are happening with finance teams in the room. Okay, so now I'll bring the attention back to the panel. What makes a good model for scenario analysis? Maybe the level of detail, the data organization, accuracy, maintenance, something else? What do you think makes a good scenario model or scenario analysis?
Maybe I can take that one first. And to me, when you're talking about scenario modeling, there's a few different things. One of them would be the repeatability aspect of it. So being able to feed different assumptions from different scenarios that you'd like to look at into a consistent model. So that's one piece. Another one is having the level of detail in the model that would help you make the proper decisions. If you don't include the details that would help you make the decision, then you're just running scenarios to look at results, but then you can't really act on it. And then being able to compare easily, right? Like it's nice to run different scenarios, but if it's such a heavy lift every time somebody throws out an assumption or a suggestion, you can't actually make a valid or reasonable comparison in a reasonable amount of time. It's not gonna work. You'll just end up ignoring it, I guess you could say. Yeah.
Yeah, underscoring that is from an economic perspective, I agree with what you said 100%. but also understanding the detail from the point of, if you change one assumption, how does it affect this intermediate variable or the data, and how that connects to this, how that connects to the top line, and that understanding the connection within the model is really critical, because you don't want to just make the assumption and see the end. But if in that case, you have no understanding, and more importantly, you don't know what to mitigate. So understanding the inner workings of the model, it's almost like opening up the hood of the car and see if this happens, what happens to that, that's connected to this, this connected to that, and having that model and sharing with everyone so everyone has the same understanding. I think that's very critical.
If I may add, I agree with both. And I think one of the things that we're seeing based on the polls is that people need more time and better tools. So I think that they're in the right place to be able to figure out the tools to be able to not only streamline their process, but at the same time, have a way to be able to centralize the data to be able to have better resources.
Yeah, I just wanted to add something to what John had mentioned. I think it's a really important point that you brought up, because there's a lot of discussion about like AI forecasting and sort of automating everything. To me, the exercise of forecasting, budgeting scenarios, it's less about having the right number. Nothing's ever going to be right. And it's more about understanding what you'd have to change based on what scenario actually came to fruition. And so it's more about going through the exercise and really understanding how to mitigate, as opposed to just having a number spit out at the end, right?
Wow, great. Yeah. So having a good amount of detail, knowing what those details are in your model, being able to communicate and act on the model. There's so much more that goes into it than just the numbers.
No, I think the process of forecasting is more important than the forecast itself, because the process prepares you to respond and react to uncertainties, because you see the connections within your organization, how everything fits together. I think that's more important. So I agree 100% with that statement.
Nice. So I'll ask the three of you again about maybe sharing with us an example from your professional experience about how a good scenario model or a well-performed analysis of multiple scenarios has helped drive a company's growth or enabled it to reduce potential losses. Or maybe it went terribly wrong.
Actually, I've been on the road again for the last 2 months. And actually what happens is we show to the CFOs mostly, if this happens, this could happen. And that triggers this whole conversation about we need to have a hedging policy. So you're showing them that it's not that it's going to happen, but this could happen. There's a 25% probability. Are you okay with it? Now, if they're okay with the outcome, maybe you don't need a hedging policy. But pretty much everyone says, oh no, if this really does happen, we're going to be in big trouble. We should do something. And the internal conversation starts. So from my perspective, scenario is not that detailed. It's more macro. I'm a macroeconomist. So if the US goes through a hard landing, we have a serious contraction, especially second half of next year. Are you okay with the outcome that this is the likely to impact on your financial statements? Are you okay with that? And pretty much everyone says no. Then we got to do something. And then that's when the conversation starts. But then they need tools, because getting a good forecast can be very expensive. Bloomberg, I believe if they're charging $2,400 a month just to access it. So a lot of companies don't have Bloomberg terminals. So you're relying on your primary bank's forecast, but getting a one forecast from one financial institution is very risky. You need to get the multiple forecasts and kind of figure out what the consensus is.
From my experience, whenever it is that you're able to have these conversations, what happens is you set expectations. And back to what John Min was saying, if the market does move in a specific way, then you can react and you know exactly how you need to act once that happens. For instance, if it goes into a positive movement, then you can continue to hedge out longer positions. If it goes into a negative, then you can consider what your different options are. But again, it comes down to being prepared. And by having these conversations, it allows you to know, it just provides you a forecasting tool to expect a way to be able to remove FX losses.
Yeah, I'll take the complete opposite side here. I think that when I was working in finance, running scenarios was almost impossible to do in an efficient way. So when we did it, it was a rare project, and it was like really a big project to actually, take all the detail into account that was necessary, so that you really act on it. And probably over the time period that we were running these different scenarios, things changed so drastically. It could be like over 2 months, that because it's, you have a full-time job of being a finance person for the company. This is an extra project. Still have to get your reports out and the budget done and all that kind of stuff, and then work on this. So it is a huge lift to actually do these kinds of things on your own. That was my experience.
Wow. Thank you. Well, things are a bit different now because, well, what brought us together in this conference room are our FP&A tools, Datarails, and a global payment solution, Monex. So after discussing like some of our pains and experience and recommendations, we would love to show the audience what we can offer to help cut some of those losses and have a bit more insight on the business through FP&A tools. So I'm going to hand it over to Emmanuel or John Min. I think, Emmanuel, you would like to show us the product for a few minutes.
Yes, let me go ahead and try to share my screen.
Cool.
And I apologize to the audience because this is not my regular voice. I lost my voice and it's now coming back. And it bugs me that this is being recorded. But let me go ahead and share my screen. Also, Roxanne, feel free to jump in and stop me because I can get carried away in showing the demo. So let me know when I need to stop. This is our platform. The platform serves as a global treasury solution. One of the things that I highlight is if you happen to have multiple entities at a global level, you can onboard multiple entities and manage the global treasury tool, right? So you could actually manage ins and outs from each and every single one of the entities. But today we want to talk about foreign exchange and the risk management and the forecasting. Going back to the polls, it sounds like a lot of times people don't have the tools nor the time to be able to watch the market or be able to execute on FX solutions. So one of the things that I want to be able to highlight that I think is very relevant is in this specific scenario that let's say that you are working with the euro, right? And from the platform, you could actually see how the euro has been moving daily, weekly, monthly, and also annually, right? But let's say that, for instance, you want to be able to get notified as the euro, let's say, reaches parity again. You could actually set a rate alert, and as the euro reaches the 1 or the parity level, we will send you an email or a text. Again, if you don't have the time to wake up and watch the market and just be behind a Bloomberg platform, seeing what's going on within the currency that you're exposed to the most, you can leave that heavy lifting for us to be able to automate those notifications so that as that exchange rate that you're looking for hits the market, we will notify you either via email or text, which I think is a very, very helpful tool. Because we were talking about, it is hard to be able to try to manage all these different expectations when you're already just busy dealing with the budget and your everyday just roll within your company. So I think that is one of the first risk management tools that we offer. One of the things that we did talk about is creating a hedging policy in place, right? I think John Min mentioned that Microsoft is doing a 50-50, meaning that whenever it is that they have an invoice or an exposure, they're able to protect 50% by hedging that invoice. So I'll show you how you could do that within the platform, right? So through the platform, you could actually go into a forwards and place a forward contract. As soon as you place a forward contract, you have the ability to either do a fixed dated or a window. Let's run with the assumption that you have net payables of 30 days, right? So let's say that we know that we need to be able to pay for this invoice on January the 12th. The currency that you want is the euro, for instance, right? And let's say that you want to be able to hedge 50% of your invoice, which is 40,000 total. So what the platform allows you to do is you're able to buy today's exchange rate for a future delivery by only placing a small deposit, right? So this is a great tool because you're actually able to secure that exchange rate. And again, if this exchange rate is lower than what your ERP had projected for you, then you're going to be able to have an FX gain as opposed to an FX loss. So again, this is one of the reasons why clients like to be able to utilize the platform to be able to protect the exchange rate and capitalize on positive market movements.
Nice. You want to show us another aspect of the platform?
Yeah, of course.
Super.
One of the things that I first highlighted was the notification, right? And again, that is just a simple notification. There's no execution. I think one of the platforms or one of the tools that the platform offers that is very, very beneficial to our clients is the ability to actually name your price. So let's go back to that same exact scenario that I had just highlighted where you need to be able to pay 40,000 euros by January 12th. You could actually place a market order. And let's say that the amount that we want, again, is 40,000 euros, right? So the platform is able to give you what the current exchange rate is. And it can also give you an idea of what the best case scenario would be based on support and resistance. So let's say that you actually want to be able to buy the 40,000 euros by, let's say, if the market reaches the 1.01, right? So we're actually able to have a target rate of 1.01, and you could either have this order be open until you cancel the order, or if you know, going back to our example, that you actually have to pay for this invoice on the 12th of January, then it is going to expire on the 12th of January. So again, you know, this is a great way, this is a great tool for you to be able to say, this is what my desired price is, and I'm just going to go ahead and place it with Monex USA. And if that price ever happens through the 24 hours a day, 7 days out of the week, then we would buy that currency. You will receive a confirmation. It goes into your holding account. From your holding account, you're actually able to manage the payments and then send the euro as you need it. So again, I think you know, the platform has a lot of different capabilities, such as doing a file import, and just the ability to do multi-currency accounts. But I just wanted to take the time today to be able to highlight things that are relevant to the discussions that we're having, which are around foreign exchange risk management and creating a hedging policy in place to be able to help you with your foreign exchange needs.
Cool. Cool. Thank you so much, Emmanuel. Now I'll hand the stage over to Jonathan to show us a taste of Datarails. I think you want to give us an example of a scenario analysis with our tool.
Thank you. Let me share my screen.
Great.
All right. Yeah. So Datarails is it's a cloud-based FP&A solution that allows you to continue working with Excel as the interface while having all the data from all the disparate sources that finance people work with inside one environment. And what that means, the culmination of all of that, is that you can actually run scenarios where the interface that you'd be working with is a simple Excel sheet, where you could have scenario A, B, C. Type whatever it is that you're looking to plan. Okay, it could be based on information that you have. It could be based on assumptions that you're making for every part of your business. So in this case, we're planning for revenue, hiring, loans, etc. Okay, costs. And these are the critical parts of this example business that we're looking at. The FP&A people can open the same exact types of templates they had used in the past, if they had any, and just submit them back to the database. From there, and this is the piece that you don't necessarily have to look at, but what we were talking about before, where actually understanding what's going on and what's driving or what's being driven off of those assumptions, you can actually go back and understand each piece of the business, because this is part of your calculation, and these are the things that were important enough to include in this type of model. Okay, the results are going back into the database, and then you can take a look at the unified outputs that all the different scenarios are living together. You have scenario A, B, C, or 1, 2, 3. You can compare, you can drill into them, and understand what's going on underneath for all the different parts of the business. In this case, we had the P&L, balance sheet, some cash flow items being represented in this output, where it's all automated, and you're just spending the time thinking about the aspects of the business they really want to focus on, and not spending the time, creating multiple versions of a templates, trying to line them up so that you can compare them. And then every time somebody wants to make a change, it's sort of a last minute scramble to get it all done. Okay.
Amazing. Yeah.
Great.
Thank you.
Thank you.
It is fantastic. This is the first time I've seen it. I can use this.
It's a
Thank
big
you.
step up from comparing Excel sheets side by side, huh?
I got thousands of spreadsheets, but this will help me visualize it. It's beautiful.
Interestingly, like one of the unique things about Datarails is that you don't have to change the spreadsheets at all. So we're not looking for you to start turning those spreadsheets into some nice tabular CSV kinds of formats.
Right.
And you don't have to load the information up to a specific dimension. We could take all aspects of the business into account. We could work with a regular structure of a spreadsheet, just like the one that I showed before. Every one of these tabs is actually a completely different structure. It's not an issue. We'll capture it inside the database and give you one spot to look at everything. Yeah.
Can I import the data from third-party sources like Fed, Bloomberg, even SAP for large company clients?
Yeah, so we can hook into pretty much anything. And you can take into account, like, to me, the significance of a lot of those things that you just mentioned, well, maybe aside from SAP, is that even if you had one nice financial platform that captured all of your relevant information, the second you start going into, let's say, forecasted Fed rates or whatever, that brings you out of the system into Excel, and now you're working offline, and all of the critical analysis that you're doing is just Excel based, right?
Roxanne, I don't know whether this ever happened during your webinar. I'm sold.
That's terrific. That wasn't planned.
I need it.
Yeah.
John, if you could just share the credit card information with us now, that will do it. One thing to add, and I don't know if we're going to cover this later on, but it just came to me, is that, as I sit there and I reflect on all the different companies that I talk to, every single company is completely different, right? They have different needs, they have different risk tolerance. So I think it is important that if you actually found, or if you were able to visualize yourself using some of the tools, please reach out to us. We're happy to do a quick demo that is tailored to your needs, right? You might have a different ERP system, you might have a different exposure, but I think, this is why we're here. We want to be able to help you, provide you with those tools without tapping into the additional time that you need.
Absolutely. I'm going to paste our links into the chat so participants can click if they'd like. And also, we have time now for questions. Happy to see that our audience has stuck around all the way until the end. And now it's your time. You can add whatever questions that you'd like into the Q&A, and we'll address them. So I just put our links into the chat and just waiting to see if any questions come through the Q&A. Any other final thoughts from our panel in the meantime? This has been a really fruitful discussion.
Expect much volatility for next year, tremendous amount. There's a big structural shift that's taking place, so be prepared.
I just wanted to thank Datarails to be able for being able to set up this webinar. I think it's very useful. So thank you, Roxanne, for organizing this, and Rihanna, and appreciate the rest of the panel as well.
Thanks, Emmanuel. We appreciate you as well. Very happy that this partnership could take place. It really makes sense. The idea of our tools working together. I hope to see more of it in the future. We got one question in the Q&A here. How about hyperinflationary economies like Sri Lanka and Pakistan? So,
In terms of
yeah, go ahead, Johnman.
Yeah, actually, I'm really worried about emerging economies with the high ratio of debt, because a lot of their debts are dollar denominated, and we do expect dollar to stay relatively strong first half of 2023. But I am very concerned about China coming on board, opening up their economy. If the commodity price is going to really take off, obviously that's going to be good for countries like Mexico, Canada, but a lot of emerging economies, they import commodities using dollars, which is getting more expensive. And with the China buying commodities, I'm sorry, I don't have a good news. I'm an economist. I think the inflation is going to really take off to another notch next year, especially the first half.
Thank you. We got another question I'll follow up with from Ivan. With China reopening and affecting commodities, specifically oil, what are your thoughts about the movements and effects of the dollar against developed countries' currencies?
We do expect dollar to be relatively strong against the G7, even G10, just because interest rate differential is massive. US interest rate is much higher than, let's say, Europe, and that attracts the money in, that supports the dollar. But looking at the second half of next year, maybe 2024, we expect dollar to weaken because we are forecasting recession second half of next year. So we're in the camp, there will be a recession. And unfortunately, it's man-made recession, or the Fed caused recession. It's not recession because housing price collapsed. It's all artificially induced by our Fed because they want to bring the inflation down to 2%. So stronger dollar first half, weaker dollar second half against the majors.
Thank you. Very interesting to get such a specific forecast, something that will affect us all. Are there any other questions that the audience is in the middle of typing? We'll give it a minute, and then maybe we'll close up the webinar a few minutes early. All right. Thank you, everybody, for participating, for speaking, for writing questions, for introducing yourselves. I really enjoyed this discussion. It's been a pleasure working together with John and Emmanuel and Jonathan, two different companies who actually have offices right next to each other in New York City, which is pretty cool. So thanks a lot for being with us today.
Yeah.
Thanks, everyone. I appreciate the audience attending and taking the time to come and learn more about us.
Yeah, thank you to the Monex team. It's been really interesting. Nice to work together.
Thank you.
Well, I'll call you.
Yeah, we'll be in touch. And for the audience, please do, feel free to learn more about us. I put the links in the chat, and have yourselves a really great weekend and holiday season.
Thanks a lot,
Bye.
Roxanne.
Thank
Bye.
you.
Thank you.